All right, we're gonna be talking about depreciation, which is the tax deduction for the wear and tear of a property. In this example, we're gonna use residential real estate. For just a quick little summary, I'm not providing like any financial advice. Obviously, you should consult with your CPA and other different types of people that specialize, just to give you a brief summary on this topic. So you have 27.5 years to take advantage of the tax deductions for the wear and tear, otherwise known as depreciation. So depreciation works is you're basically getting a deduction for the depreciation of the building itself and the contents inside. You do not depreciate the land itself. So for example, you pay $600,000 for a residential property. You paid $100,000 for the land, roughly. We'll just use this as an example. You would be able to make deductions off the other $500,000, and then you divide that between the building and also appliances. You can deduct about a rate of 3.6% for the building, which is the building itself, the actual physical structure, not what's inside, just the building itself. You can make the amount you paid for that, you can deduct 3.6%. For the contents inside, you can go for a good deduction of 20%, which is another way to also go about this is doing cash segregation, which is highly recommended, which is when you individually assess every appliance, and you basically crack down, you go way more detailed into it to give yourself the most you can get out of depreciation, which is a fun fact, is that cash segregation is technically required, but it's not really enforced by the IRS. So why not do it though, right? If you can get more out of your depreciation deductions. So also, and you may wonder why the government also gives you all these advantages with real estate, why all these tax benefits are given the people who invest. The reason is real estate benefits the economy. You know, you provide housing, you know what I mean? You provide housing, for example. I mean, that's why business owners, think about why business owners also get tax deductions. They provide jobs, real estate investors provide housing. There you go, you end up getting tax deductions for these, and then that's how they end up paying you back, basically. So I guess a good example of how it appears, let's say if you get $15,000 yearly cash flow on a property, and this is after taxes. This is basically after, like, not after taxes. That's not what I'm trying to say. It's after you pay your mortgage, and you know what I mean. You take care of the financing of the property for that year. You're left with $15,000 cash flow. So what happens is, let's say you you get $30,000 worth of deductions from your depreciation. So you get $30,000 from the depreciation of the building itself and the contents inside. That $15,000 of cash flow is overridden by the $30,000 of depreciation. So then therefore, you do 15,000 minus 30,000, it shows up as a $15,000 paper loss. So basically, you get the cash flow goes on tax-free, and then you can also use that negative 15,000 or whatever you call it to get a better tax return. This topic's a bit harder to explain than some of the other topics, because this is when we're kind of diving deep into more of the, you know what I mean, the taxing of real estate and others. So it's not just a simple structure, how to renovate, you know what I mean, how to decrease operating expenses and all that. It's not just the basics. We're kind of diving deeper into the bit of the tax categories of real estate, I guess, and then maybe we'll even get to asset protection too. So thank you for checking out this video. Let me know if you want to see anything else about tax deductions, wealth in general, real estate in general. I'll even go into the stock market as well as asset protection. So thank you so much for watching. I appreciate it. See ya.